This is Module 12B, and this is going to continue our study of cost structures, looking at variable, fixed, and mixed cost. Before we move into the content of Module 12B, let's go back and let me give you the solution to the 4 practice questions that were attached to your lecture notes in Module 12A. The first problem that we were looking at was computing the break-even point, and we can do that in terms of units or we can do that in terms of dollar sales. In either case, we're going to be taking the fixed cost and dividing by the contribution margin. To find the break-even point in units, we would use the contribution margin dollars, in this case $3, and we find that this company breaks even at 150,000 tickets. To find the break-even point with sales, in terms of sales dollars, we need to divide by the contribution margin ratio. In this case is 60%, and this gives us a break-even point at $750,000 of sales. Problem number 2 asks you to predict the profit, and if we know the break-even point, we know that we're 25,000 tickets below the break-even point. We multiply that difference times the contribution margin per unit, and we can predict, in this case, it is not a profit at all. It is a loss of $75,000. Keep in mind that the contribution margin before or after the break-even point is going to contribute directly to the profit or the loss, and in this case, because we were below break-even, it was a loss. The third problem had to do with finding how many tickets we need to sell to earn a desired net income, in this case $300,000. So now our contribution margin of $3 is going to cover not only the fixed cost but the desired profit, as you see in the numerator. So 250,000 tickets will bring us a net income of $300,000. We saw in Module 12A that we could always prove our answers by preparing what we call a variable costing income statement, or an internal income statement, which shows us the contribution margin and proves this net income of $300,000. What if we wanted to know the before tax profit? In other words, how do we convert $300,000, which would be considered after tax, to the before tax amount of profit? Well, you simply divide by 1 minus the tax rate, and in this case the tax rate was 25%, and this gives us a before tax profit of $400,000. When a company has multiple products and wants to know its break-even point, it has to know the contribution margin for each of the products, and it has to know what percent of the sales relate to each product. So we compute a weighted average contribution margin here by using the 90% and the 10%, and then we divide our fixed costs by this weighted average contribution margin, and this results in the answer you see on the screen. A special type of problem that we learned in the last module was about scarce resources. And when we have scarce resources, the concept is we need to find the amount of contribution margin we can earn per unit of the scarce resource. So in the problem you were to work, the scarce resource was machine hours. The contribution margin for product A was 20, and it took 2 hours to make a unit. $40 of contribution margin for product B, and it took 5 hours. So we compute contribution margin per the scarce resource, in this case being the machine hours. So in this case, product A would be preferred, and if demand is there for product A, we would be better off selling and producing and selling product A because it has the higher contribution margin per the scarce resource. today's module 12B, is going to focus on what we call the degree of operating leverage, known as DOL. We will also look at fixed cost, variable cost in terms of outsourcing decisions. And finally, we will look at the decision that many companies have to make whether to drop a particular product line or department or to keep it open. Let's begin our discussion of DOL, or degree of operating leverage. Operating leverage is about the composition of fixed cost compared to variable cost within a company. When companies have a large proportion of fixed cost, and this would be a company such as a chemical manufacturer or an airline with all their fleet of airplanes, companies like this have very high DOL because they have a lot of depreciation, they have a lot of fixed cost. When a company has a high DOL, their particular net income is very volatile and very subject to changes in sales, very sensitive to changes in sales. So a little bit of change in sales can have quite a large effect on profits. The other end of the spectrum would be a company with very low DOL. This could be perhaps a company like we had in the Tri-Cities that was called Molly Maid. This was a housekeeping or house cleaning service, and they really had minimal fixed cost. Many of their costs were variable. If there weren't houses to clean, or there were fewer houses to clean, many of the costs disappeared. In other words, there was a large proportion of variable cost and few fixed cost. Now, a company like this is not so sensitive to changes in the sales volume, and therefore they do not carry as much risk as a company with very high operating leverage. Let's take a look at two companies. One's going to be one with a high degree of operating leverage, and the second company will be one with a much lower DOL. We will first look at the high DOL company, and let's say this company has a product they sell for $20 with $4 of variable cost per unit, and this would have a normal sales volume of about 10,000 units. With that information, let's prepare a basic income statement. This would be $200,000 of sales. Our variable costs would be $40,000. We would have contribution of $160,000, fixed cost of $120,000, and net income of $40,000. Now, if you look at the difference between the sales price and the variable cost, we have a $16 contribution margin in this case, and we have a fixed cost level of $120,000. To compute the degree of operating leverage, we take the contribution margin and divide it by the net income straight from the income statement. So we would have $160,000 divided by $40,000, and our DOL would be 4.0. Now, what this is going to mean is that if we have, for example, a 5% change in sales, then we will have 4 times that amount of change, or that percent of change, in our net income. In other words, a 5% change in sales will cause a 20% change in net income. So let's take an example. If our sales drop by 20%, the net income drops by 4 times that amount, 80%. Now, we're asked to predict net income, and we do not need a statement or the preparation of a statement to do that. Let's take 80% times 40,000. And this says that our sales our net income is going to drop by $32,000, and this would make our predicted income 40 minus 32, $8,000. So we went from $40,000 in profit to $8,000 by a 20% drop in sales, which equates to an 80% drop in net income. Now let's go the other direction. If sales increase by 10%, net income will increase by 40%. If we take 40% times the net income, we're going to get an additional $16,000 of net income. That will be the amount of increase. So 40,000 plus 16 equals 56,000. All right, now if we set that aside, we'll do the same thing for a low DOL company and look at the effects from this type of situation. This company has a sales price of $20 and variable cost of $12. Sales volume is, again, about 10,000 units. Now keep in mind, this is the low DOL. We have, let's say, sales of $200,000, variable cost of $120,000, contribution margin of $80,000. This company has $40,000 of fixed cost and net income of $40,000. Now again, you'll recall the high DOL company that we just looked at also had a net income of $40,000. But this one is going to have a lower DOL, $80,000 divided by $40,000, and a DOL of 2. Now by having this lower DOL, or degree of operating leverage, we will not see such drastic changes when we have these changes in the sales. If the sales drop by 20%, net income will drop by 40%. So 40% again times 40,000 is 16,000 would be the drop. And 16,000 taken away from the 40 leaves us with a predicted income of 24,000. Let's look at an example with the sales going up by 10%, then net income will be 2 times that, or a 20% increase. 20% of 40,000, of course, is $8,000. So the predicted income is 40 plus 8, or 48,000. The high DOL was 4 in the company we looked at, and the low DOL was 2. They each started with 40,000 in income. The high DOL company, when our sales plummeted by 20%, the predicted profit was $8,000. When sales went up, the predicted became 56. And we will log in what we saw happen with the low DOL company. This one, with a 20% drop, ended up at 24. And when sales were increased by 10%, we ended up at 48. Now, by looking at these side to side, you can see that the high DOL net income was much more volatile, much more sensitive to changes in sales, both when we dropped in sales and when we increased our sales. So let's draw a conclusion from what we see. A high DOL company's net income is more volatile. And what we're saying, it is more sensitive to changes in the volume of sales going either direction. This company carries more risk. The concept of risk in terms of cost structures leads us to the subject of outsourcing. In your lecture notes, you have a lot of the qualitative considerations when a company may outsource either a function or it may outsource the production of its product, or it may outsource maybe just the production of maybe a part or a component of its product. Outsourcing it's a good time to talk about the outsourcing right now, because we are thinking about risk, and companies who want to control the risk that comes from having a higher degree of operating leverage will sometimes consider outsourcing decisions, because when you outsource, in many cases, you are letting go or giving up your fixed cost and trading them for variable cost. When you trade fixed costs for variable costs, you are reducing your degree of operating leverage and in turn reducing your level of risk. Let me give you a few examples of outsourcing. At ETSU, the cafeteria and the bookstore are outsourced. At Eastman, the travel arrangements are all being done for the Eastman employees who travel nationally and internationally. These are being handled by an outside vendor, so this function has been outsourced. Sara Lee, the maker of delicious coffee cakes, they've gone through the cycle from making these cakes to, for a period of time, they actually had the whole production function outsourced, and somebody else was making all these coffee cakes, and Sara Lee was doing the marketing only. I think I read recently that Sara Lee is again back making their own coffee cakes. Something to think about, even though you would like to trade fixed costs for variable cost, and this is possible sometimes through outsourcing, you should never outsource something that you do especially well. Let me give you an example of how fixed cost can be substituted for variable cost through outsourcing. A good example might be a small chemical company that really needs the services of an environmental engineer to check the waste levels, the environmental impacts, and so forth of this small chemical company. But these people are well paid, and if they are employed by the chemical company as a full-time employee, they will be receiving a salary, which would be a fixed cost, of course, for this small chemical company. What they may want to do, instead of having this fixed cost, is they may turn to an outside engineering consulting group to get an environmental engineer to help them with the work on an as-needed basis. Now, when you do that and you bring in the person from the outside who actually works for the vendor, they typically charge at an hourly rate. So you're giving up a salary, a fixed cost, for a variable cost, which is an hourly rate. Another way to save on fixed cost, a second example, would be companies like to outsource data processing functions, because again, to do those functions, it would require an extensive capital investment. So what you could do is, if you have this done on the outside, you would pay for these services on an hourly basis, a variable rate, instead of having this cost, this depreciation, this fixed cost of all this capital equipment if you chose to do the function yourself. The last subject that we're going to talk about as we conclude our study of cost structure is this decision that many companies have to make as to whether to keep a particular department open or to close it. Now, it usually is the case that management has watched the profitability or lack of profitability of a certain department and considers that department a potential candidate for closure. One thing we have to be sure about is that when we make that kind of decision, that from an accounting perspective, that we present the numbers in the correct format. because this will be absolutely essential if management is to look at the numbers and make the most reasonable decision. Unfortunately, some management may see an income statement that you've seen often in this course. This is our variable costing statement, which just separates our variable and fixed cost with our contribution margin in between. If a management team is looking at this structure of an income statement, it is possible that they will make the wrong decision. They will keep it open when it should close, or they'll close it when it should stay open. Keep in mind that these are very important decisions for companies, and they will be getting input from many other areas besides accounting. So keep in mind, we are just showing the perspective from an accounting perspective, and this is going to be one of many viewpoints that are considered when these big decisions are made. The problem with this format is right here. Let me show you a decision tree that I would like you to become familiar with that is appropriate to use when you're trying to decide whether or not to close a department or product line. If you'll start with me at the top, if you take a look at this statement, this would be all fixed cost. So this would be right where we start the decision tree. To help management lead them to the correct decision in terms of the accounting numbers, we have to take the fixed cost and decide how many are direct, how many dollars are indirect. Of course, we remember what those terms mean. Direct means it can be traced to the department. Indirect means it could not be traced to that department. But these are, in essence, allocated cost, or common cost. So, for example, if we had fixed cost of $200,000, and we could trace some of those fixed costs directly to this department that we're considering closing. This could be, for example, supervisors that only work in this department. Let's say that this would be $80,000, and the indirect would be $120,000. These all have to tie back to $200,000. Then what we realize is that these are just allocated costs, and we understand what that means, that these are costs that are shared by multiple departments. If we look at the direct costs, then management will have to make some serious decisions before we can decide which are avoidable or unavoidable direct fixed cost. Let me give you an example. If we have supervisors, maybe one supervisor that we're going to let go because the department would be closing, if this person was terminated with the closing of the department and they make $40,000 a year, this would be considered avoidable. Let's actually make that $50,000. $50,000 avoidable. And this is the only avoidable out of all the direct fixed costs. So this would make this one $30,000. Now, what do I mean unavoidable? Well, maybe this is another supervisor who, instead of letting them go or terminating their employment, we're going to take this person and just assign them somewhere else in the business. So we will still have their salary to pay. It's just they won't be in this department anymore. Now, if you look at this, what's going to happen is out of $200,000 of fixed cost, only $50,000 is going to go away if we close the department. What will happen is the $120,000 that's been allocated will get distributed to the remaining departments. And the $30,000 here will also end up on the back of another department, because remember, this is a supervisor who's going to be reassigned. So what we want to do is clearly understand the terms indirect and direct, which has to do with traceability, and the terms unavoidable and avoidable. Avoidable means the cost will go away if you close. Unavoidable costs do not go away and have to be absorbed somewhere else in the organization. Let's go now and put the numbers in the format that we would want to use when we were trying to make such a decision as to keep a department open or to close it. We have a income statement now that's going to show the sales. And let's say the sales are $500,000 for this company. Variable cost, we will use example of $345. Contribution margin of $155. Now, what you'll see next is what we need to change from the traditional way of doing this type of statement. We only want to subtract avoidable fixed cost. And so we would look at our decision tree, and it shows us that we only had $50,000 of avoidable fixed cost, and we compute what is called the product margin. And this product margin turns out to be $105,000, and it is positive. What this product margin tells us is that this particular department is contributing, it alone is contributing $105,000 to the overall profitability of the company. Close this department in error, that would cause us to drop our profits by $105,000. So it would be a serious mistake in this case to close this department, because closure would eliminate these sales. Closure would eliminate variable cost, which would eliminate the contribution margin. The avoidable fixed costs go away, and we would lose this much in profit. Now I want to show you the income statement that would have been prepared if we had not adapted this income statement appropriately. In other words, I showed you this earlier, that the typical statement looks like this: all fixed cost and then net income. For this company, this standard income statement would have showed numbers that look like this. Remember, fixed cost, if you look at the top of the tree, the decision tree, it was $200,000, showing a net loss for this department. So I think this example shows you that if you use this type of income statement, it is very likely you will make the wrong decision. By using the correct statement, we are able to not only make the right decision, but we can also see exactly how much profit that particular department is contributing to the overall profitability of the firm. In this case, $105,000. As we conclude this module, I just want to remind you that today we talked about degree of operating leverage and how highly leveraged firms, those that have those high fixed costs, incur a great deal of risk. We talked about reducing that risk possibly through outsourcing either some of our functions or some of the products that we make. And finally, we talked about making a decision to close a department and how it's very important to look at fixed cost and determine if they're direct or indirect, and then accordingly look at the direct cost and determine whether they are avoidable. Will they go away if you close the department, or will those costs be unavoidable? They will stay with the company and have to be absorbed elsewhere.